Righto, Money Miners. Before we get into the king of hedging, the hedging update for the gold industry, Sean Russo, Trav, mate, we're not us, but other people are on fire. Hobbsy's bloody Woodsmith episode.
Killed it.
Killed it.
How good was that?
Fucking
I
actually
think he killed the project. He definitively put a bullet in it, never to surface again.
Mate, well done, Hobbsy. Bloody
get in touch, give him a job. Hobbsy at moneymind.com. Offer him a bloody job.
And I will clip the ticket on that. The live wire, our bloody first live wire episode's out, Trav.
How was that?
The great James Marley interviewing us.
Yeah.
And it was a bloody privilege. Go check it out on the Live Wire YouTube channel.
Yep.
That's all you need to know.
Mate, you haven't taken the hat off since.
No, I love wearing someone else's hat because I don't look like a promotional dickhead then. So, right, let's get into the king of hedging. Here we go. Righto, Money Miners. When you come to Sydney, the first call you make is to the king of hedging.
Oh, God.
Sean Russo. Good to see you again, Cobber.
Nice to see you, Matty. Welcome all to Sydney.
Yeah,
Thank you.
God's
Cheers.
country. Don't have to welcome us here. Bloody going straight to the Paragon later. Go see what all the bloody hopes, where all the hopes and dreams are.
Fantastic,
mate. Well, we thought on follow up from last year's yarn with you about which was the real in the weeds and I guess probably intro to hedging. We thought why not follow up on hedging now in terms of a gold price elevating and how I guess the environment has changed and
sure.
Who's winning, who's losing, who's exposed. So, mate, what's your initial lay of the land right now?
So last week, quite predictably, one of the brokers in Perth put out their summary. They've now got all the quarterlies, and they put out a whole big hit list of all the negative hedge books. Right, criticised all the companies that have got hedging, and this is how much they've lost, and this is the sort of the cash loss to the quarter if you deliver into hedge. And I look at it and I go, saw a quote in Mad Magazine when I was 10 years old. The optimist sees the donut, the pessimist sees the hole. Yes. Stuck with me for the last 51 years. Yeah. Now, I don't understand why that broker is rabbiting on about the hole. Because in the same article, they praised a couple of the people that had negative hedge books, saying how well they've done, right? Because it's the donut as an investor that we're interested in. Is the share price gone up? Is the share price outperforming gold? How's it doing relative to the other companies that we could have bought? Are we ahead? Because I think, hedging gets done for a whole range of reasons. If it gets done because management thinks the gold price is high, get out of Dodge. The minute that you see anything in any way, the chief executive or the CFO starts talking about, we locked in the price is so good, or it's over this or it's over that, that's a view on price, and none of us know where the gold price is going. The most dangerous person in the room is the person who thinks they know, right? Like even you talk to hedge fund managers, you ask them for a view on where's gold going. I don't know. But right now, this is my view, but I reserve my right to change my mind, right? Now, when you do hedging, you're doing it for quite some period of time, so you need to have a good reason. Now, most of the people that in Western Australia that have hedging, that have been successful, have had hedging for a reason, to support debt. And if you use hedging to lever and build, then you issue less shares. So the cost of hedging, measured now by this broker last week, the cost of hedging today has to be measured against the value of dilution avoided. So Capricorn is a really good example. I'd say to you Capricorn has the lowest hedge price of anyone in the industry, now that Regis bought back. A little similarity there. Yep. For the readers will know, the viewers will know about. So Capricorn's got the worst price. They don't have the largest hedge book. I don't know why they've still got hedging so long after they borrowed money, but the average investor in Capricorn's going to say, who cares? I mean, they've got the best share price appreciation of any one of the hedged peers over the last 5 and 10 years, right? Of any of the producers. So hedging hasn't hurt them. Now, can you get into the weeds and go, they would have done so much better? Imagine if they delivered into their hedges earlier. Yeah, if they delivered into their hedges earlier and stuck to the original program they had and not rolled some of those hedges forward or done other things, they'd probably be in a better position today from a negative mark to market on their hedging, but might they have had to issue equity, for a thing in the past? So you just can't know. So I think the key is whenever anyone talks to a mining company, what's it for, right? What's it for? And if it is a valid reason, then to avoid dilution, to create certainty. I think Northern Star, if you ask them, they've got a massive capital expenditure on the super pit that they need to do. They can't afford in some quarters in the future to not be making fairly decent margins because they don't want to go backwards. Yeah. And the market doesn't want them coming back to raise more money. I mean, and they're already in a position, they're so big now, they're lucky to even match the gold price. I mean, that's their problem, right?
And I mean, they've copped a bit of criticism going, you've got almost 2 million ounces in hedging, but, they've kicked back and sort of said, well, that's about, 20% of our, say, average annual production and whatever, or resources or reserves or something. Yeah. So it's like, well, actually, we're still more exposed to the spot price than we are, but we're sort of underwriting, our business in that sense.
Oh, the way we like to look at it, the really simple metric, and we send out to all of our clients each quarter, the landscape, and we take this, we figure out from the public announcements the spot equivalent price. So if you had to close the hedging out today, what would be the loss, if you like, and how many weeks. So to try and normalise the hedging across the whole peer group, we just go, right, what's their annual production? What's their total hedge book? How many weeks of production does that represent? So a lot of companies you'll find have got between 35 and 40 weeks. Northern Stars would be a little bit more than that, but not a lot more. But it's around that. So they've got like 25% of the next 4 years or something. Well, then that's 52 weeks of hedging. I'm not saying that's what their number is, but if it was, and it would be generally they taper down over time. They're not a client, but we have been involved with them in the past. So tapering of the hedging, adding to hedges over time at higher prices. I mean, one of the big things is the most important thing to look out for when you're looking at companies is, does their hedging book improve quarter on quarter? Because in a rising price environment, if you're delivering in to old hedges, they're likely to be at lower prices. You're putting new hedges on at higher prices. The average price should be increasing. Now, I saw a Canaccord webinar they did late last week where they had a couple of fund managers on, a couple of producers, and hedging, interesting, the guy introduces the subject by saying the dirty word of hedging, right? I mean, just to set the frame of the discussion, but brokers you talk about incentives, brokers have an incentive, they don't like hedging. Hedging supports debt replaces equity, right? So brokers are always going to be negative on hedging, I think, until the price goes down, and then you've got hedging that's in the money.
To save the equity.
Yeah, but the guy from Sprott, he made that point that he said, the thing that we're looking out for is companies that have hedging, and then they start to do more hedging to try and average up to make the other hedging not look so bad. Whereas we've always said to our clients, you did a hedge, you did it for a good reason. Go back to my earlier point. We're now at the point where you committed to deliver in, you deliver in. Now, if you don't, it's debt from this point on. Like, that's the way we sort of try and get it in the psyche of clients, and I would suggest the same for investors. The minute you see someone, and Regis is the obvious example. Regis just kept on rolling their hedging forward. That has ceased to be hedging many, many years before they bought it back. It was essentially debt. It was a gold, and worse still, it was a gold-denominated debt because it was growing as the gold price went up. It was at or below their all-in sustaining cost. So it wasn't creating any value or any protection to the gold price. It was a gold-denominated debt. And I think that's what you always want to be watching out for, people who start rolling hedges further forward. Sometimes you can't in a mine startup, maybe once, but beyond that, it's just financial jiggery pokery.
Yeah, so I watched that webcast, the same webcast, and a lot of it was centered around the rising cost bases for these producers. But I know they're not hedging their whole fucking profile. Like, they're only hedging, as you said, possibly 20%. But if you are hedging for protection, you wouldn't, in a very simplistic term, if the gold price is rising, that means your cost base is rising.
Yep.
So you're losing out a bit there. But then if the gold price is going down, theoretically your cost base should be also going down as well.
Well, I think on that same conversation, one of the guys made the quip that rise and fall doesn't happen anymore. It's just rise and rise.
Stewie was
costs very rarely fall. Except for maybe fuel. So gold and fuel are both falling. Now, on that, one of the things that's very interesting, that guy from Sprott again said, hedging, we hate it, we don't like it, we discourage it. But if you could hedge your costs, that would be great, which is how they got into that second part of that conversation. Now, we talked about, just before we came onto the air here, like the really bad hedge books in the late 90s, early 2000s, a lot of them were made much worse by the fact that people locked in $1,000 into the future. Gold had never been to 1,000, great. But when they did, in their model, they used the spot oil price of $30 a barrel. they're burning diesel for power in remote sites, and when they get to the maturity date of that $1,000 hedge, the gold price is at $1,200. It's not too bad, except the oil's $120 a barrel. And so that's what drove those early hedge buybacks, is actually the margin compression of these guys. They were like so we always say to our clients, and you'll see some of our clients do hedge their fuel, we say if you're going to hedge gold, hedge the fuel as well and actually hedge the margin. Yeah. Lock in the margin to the extent you can. And we've also said to our clients, like the two costs that you can hedge in an Australian mining company easily is fuel, and you can hedge the $8, because if we get into a rising $8 environment like we did in the 2000s, we've always said to our clients we think they should buy calls on the $8 as a cost mitigation, because if the $8 starts going up alongside gold could go sideways in $8 terms, costs of importing materials becomes, whatever. So you get a change in the price. And the big thing is you just don't get the same margin expansion the US producers do. So, but we encourage people to look at hedging fuel. And at the moment, you can get 25 barrels of oil for an ounce of gold. On a rolling 2-year average, that's probably close to all-time highs. So it's never been cheaper. You've never had to produce less gold to pay your annual fuel bill. So we are trying to encourage our clients to think about, well, how do you hedge a very modest amount of gold and lock in your fuel? Because the relative, that's going to be one of your biggest things if costs go up and gold goes up. So if you are locking in gold for solid reasons, why not lock in the oil as well and reduce that risk of margin compression?
How much is fuel for a year? For say a 200,000-300,000 ounce producer?
Look, I honestly couldn't say, but I can tell you that around COVID, with one of the larger producers in Australia, we had a conversation. We said, we really think you should hedge your fuel because oil prices are just unbelievably low relative to gold. It's just ridiculous. He goes, well, they're not really meaningful in the cost of our business because we're on the grid.
Yeah.
And a year and a half later, we had the same conversation. He's asking about hedging fuel because the price of fuel had gone up 5-fold. Yeah. It had gone from not being very much of their cost base to a very substantial amount. So you remember like 18 months, 2 years ago when oil went nuts. Now those people could have locked in at 1/5 of the price. So any cost in your business, Matty, if it goes up 5-fold, it becomes very significant, right? Yeah. And if you're burning it for power and stuff like that, even more so. So a lot of our clients do say it's not significant enough. And we kind of go, well, if it's 10% and it could go to 20, that it has the potential to be significant. So why not hedge it when it's not? Because if you hedge it at here and it halves and gold doesn't move, no one's going to get too angry that it's still 10% of your costs, not 5%. But oil's got a much greater risk, I think, in the next 3 to 5 years of being higher than lower. If you look at the geopolitical, you look at the whole EV thing starting to unravel a bit, whatever. Oil, I think people are vulnerable there. So yeah, so we'd be looking at that.
Very interesting.
To tie back the comment made on Capricorn and your other comment saying that it's impossible to predict the future.
Yeah.
What should Capricorn do today?
Well, if Capricorn had been our client for the last several years, we would have been encouraging them to stick to the plan and deliver in to their hedging on the original schedule, and perhaps replace those hedges at a higher price and a more modest percentage.
Yeah.
And so if you look at that the landscape of hedging over the last 4 or 5 years, because it would be almost that long ago, they did that. It must be the price they've locked in when they did the first Carl Winder financing.
2019 or 2020.
Yeah, something like that. Our clients have seen their average hedge price increase every year as they delivered. And we encourage our clients to sort of sell up the curve, so their earliest hedges would be lower, deliver into those, and over time, slowly walk your hedge book up. Yep. Not take hedges here and roll them out several years, which creates more cash now, but that's the seeds of the same. Those are the actual seeds of the ultimate kind of unraveling of what was an unbelievable success story at Regis in its last chapter, when all of a sudden the gold price just really took off.
So they're the consequences, the free cash flow over each of the past quarters going back.
Regis made lots of money in the short term, always achieved cash, paid out big dividends, but you had this sort of ticking time bomb, in the cellar. If the gold price went back down, that would have been fine, but it didn't. It went up. And I think in general, you've got to assume in the long run, the way politicians behave, I'm confident saying in the long run the gold price will go up because they're not going to start printing less money.
Yeah. And then to tie back on Regis, they obviously, I think subsequent to when we spoke in August of last year, did the big buyback.
Yeah.
I think they spent $98 million off the top of my
Yeah,
head.
what a perfect time to do it too.
Yeah,
Look what the
well-
gold price did following that.
Well, up until the day they did it, they couldn't have done it at a worse possible time. Because it was the high, but you're right, thank goodness.
But it kept going up after
Oh,
that,
no,
didn't it?
absolutely. Thank
Yeah.
goodness they did it when they did it.
Yeah.
I mean, I think
Yeah.
that when they bought it back, the gold price had never been higher.
Yeah.
But thank goodness they did. But it's
We could have
some-
said that 5 years ago
Yeah,
as
yeah,
well.
Yeah.
Absolutely. At some point, though, Matty, and at some point you've just got to look at it and go, well, this is, we've got to stop. And there was a lot of debate for the year beforehand. David Baker Steel was very vocal. They should go in, they should buy it back, they should do whatever. Look, I mean, what's really fascinating, Saracen in about 2017, 2018 had an almost identical hedge book to Regis. They had a similar size, similar out of moneyness. Regis had been selling spot and letting their hedges roll to get over the flooding and things they had, the sort of setback they had. If you remember, I think it was Moolart Well or one of the mines flooded anyway.
Well, James at WA Waterbores would have told them about that water before they got there. Trav?
Mate, he predicts the future.
Yeah, he doesn't predict, he finds the future. Mate, WA Waterbores, they find the water. They tell you exactly where it is. So I don't know if they had a part to play, if they knew that water was there, because if they did, it was probably James that told them. Mate, they can even get that bloody water out to use it.
Oh, yeah.
James is Latin for water.
I didn't know that.
Yep, and WA Waterbores is Latin for the best in the business.
Oh, mate, it's fortuitous.
It is, mate. It's like you think water, you think James, you think WA Waterbores, you think best in the business, mate. Everything, borefield, bloody construction, installation, exploration, everything water related is James at WA Waterbores. Goldfields, paleo, channel specialists.
Next time I buy a pump from the servo, I'm going to think of James.
You ask James first which one to get.
The lime flavoured pump water. It's my favourite.
That one. He will critique that as well. Cheers, James, WA Waterbores. You're a fucking legend.
They had quite a big setback, low production, so they kind of maximised cash. They didn't have to draw down on debt.
If you got well in the name,
Right.
there's, there's water.
Probably a sign. and on the other side, you had Saracen had just gone through a period of Thunderbox and developing Thunderbox, and they never had to draw down on the debt by maximising their spot sales, and they did it out of cash, but they had the hedging. But both those companies then had the gold price started to rise. Well, what do we do? And Saracen took a very active view that they would deliver in. So every quarter, if they had a bit of surplus gold or they didn't need any more cash in it, they would just deliver more. They would actually accelerate deliveries into their negative mark to market. And so they had a 70 million or 80 million negative mark to market, I think, at the time. And I remember, and they delivered, and they ate it. Right? And we sort of had this discussion, well, how do you eat an elephant? One mouthful at a time. Like every time you get a chance, just deliver a little bit more in and get rid of that hedge book, because that's going to eat you up in the long run. Now, so that the parallel track of where Regis is today and the percentage of Northern Star that Saracen shareholders own lays out quite clearly the perils of that strategy of imagining that if you roll negative hedges now further forward, that time might solve that problem.
Yeah, so if you surmise what you think Capricorn's strategy is, because they're not a publicity company or anything, they just do their job, make their cash, and I like that.
Yeah, great company.
But if the way they've done like their short-term buyback of the hedge, so they're not exposed to the hedging now. They've bought the call options.
Yeah, they removed their hedge obligations for a period of time.
Yeah. And now they're going to kick back in this financial year coming. So, and would you say, right, they've done that to maximise their cash flow to fund Mount Gibson?
Yeah, so
most likely.
Yeah, that's right. So they didn't say, but again, if I was asking, I'd say, well, what was the reason? If they said, well, we had to draw down on debt, or we could get rid of those hedges, we could, but they used cash to buy it back, right? So they ran their cash down anyway. So it's a bit of a funny situation. But they've got one of the lowest all-in sustaining costs. So they still have a fabulous margin between their all-in sustaining cost and the hedges they still have. So they can deliver gold in, but how long are their all-in sustaining costs is going to be $1,100, $1,200? While they are, I'd be trying to get rid of those lower price hedges as fast as I could, even if that was at the expense of selling spot. Yeah. Or if you put some hedges on at these prices, get rid of the lower ones and at least bring the average price up so you don't get that huge digestive problem later on.
Well, let's weigh up, not a who's right, who's wrong, but why companies that, like, you've got your, like Northern Star, as you've mentioned about their hedging policy. Ramelius, they've still got a lot of, was it 20 or 30% was hedged or something in the mid 20s.
They'd have about 40 weeks of production hedged.
Yeah. If you go to the other side, then you've got your Westgold, Resolute, WAF, Emerald, all unhedged.
Here's a really good example. Let's take WAF and Perseus. All right. So Perseus has hedging. Perseus has always had hedging since 2012 when they did their project financing. I think they've probably got about 30 weeks of hedging and an average price spot equivalent today of 2050, 2100, looking at their public numbers, right? So around 2000. So not far off where the spot price has been until very recently. Perseus just gets about their business and they've expanded and done all that. WAF, I think I did a word search in one of their presentations. They are the most unhedged gold mining company in the world. Not just because they don't have any hedging, but because they refer to their reserves as unhedged, their resources as unhedged, and they refer to themselves as an unhedged gold miner.
Every single announcement was
21. I did a word count. 21 times they said they're unhedged. Now, fantastic. But they're borrowing money to build a gold mine in Africa. I don't need... And if I want to be geared to the gold price, I can borrow money and buy gold and not have all the African risk and whatever else. And the interesting thing is their share price performance the last 5 years is on a complete parallel on a relative basis and against gold to Perseus. So like if you think about the choice, like you've had no benefit in being an unhedged WAF over being an hedged Perseus.
Yeah.
And I think, this is I was really surprised in that same thing, the Canaccord thing. Rally's been a client for years, and I was very happy to be a Saracen shareholder just on the strength of him and the way he talks and the way he thinks about things. He made the comment in the thing that people buy gold shares because think the gold price is going up. I don't agree, or to the extent that brokers and people tell that gold producers that, it seems quite irrational to me. Like the idea that the only reason you buy a gold mining company is because you think the gold price is going up. If you think the gold price is going up, borrow money and buy gold. It doesn't have any of the jurisdiction, political risks, all the risks of costs going up, whatever.
I suppose the equity gives you a lot more leverage to that.
Well, does it? So does it? And this is the question. The last 5 years, Northern Star has just matched the gold price, just matched. All right. Now they've given dividends, so. I did the maths before I came here just to check on a few of these guys. So Northern Star's about even for the last 5. The previous 5 outperformed it enormously, right? But the bigger you get, the harder it is to really try and add some. What's your favourite new word? Torque. Yeah. So it's very hard the bigger you are to really get a bit more torque, right? Yeah. But Agnico Eagle, who I looked at because they've got some Australian assets and big US and they're unhedged, just matched the gold price. The XAU, right? If you just bought the XAU, so you didn't discern between well-run companies and just said, okay, if I'm going to buy gold mining companies to outperform the gold price, I'm going to buy the XAU, basket of currencies, don't need to do any work. Just match the gold price. Just matched. And for long periods of time, it's only, they've underperformed, right? So if you're a rational investor and you come and you want exposure to gold, unless you can find a gold mining company that's strongly outperforming gold, why wouldn't you just buy gold? And it's growth. It's well-run management, it's exploration success.
Alan Trench pointed to this, and I think he'd done a paper on it, or he referenced a paper on it, and he found the same conclusion as what you've just said. Unhedged versus hedged, you actually didn't see outperformance by one side. Okay,
so then I'm going to say, but it's subtle in where the outperformance comes in. So the broker that was the broker that was concentrating on the whole, not the donut, one of the companies where they were doing that was Ramelius. And what are you going to do? Ding, ding. So shareholder of Ramelius and they're a client. Ramelius's share price has performed very well, notwithstanding that they have this out of the money hedge book, right? It's done well. It's done well on its own basis relative to gold and relative to its peers. And I would argue one of the reasons is because it's a long time since Ramelius went to the market and issued any shares, right? Drive the brokers mad. But why is that? Because the hedging in my observation, it gives them confidence, because if you ask that company why do they hedge, they say we hedge to create certainty in an uncertain world. They don't put that's my word, but that's my summary of what they're saying.
They
so
hedge their fuel
we
as
don't.
well.
Yeah, they do, and again because they got
Hedging
religion,
their margin.
Matty, about that idea. That idea that you lock your margin. So they hedge their fuel as well. So they're saying we don't. They're not saying they know where the oil price is going. They're not saying they know where the gold price is going. They're saying they don't know, but they know they're going to have to spend this much money to get from here to there. They know they've got a diminishing resource, create some level of stability. Now, I think they said in their latest quarterly they're reducing the amount of hedging. That's perfectly rational. Prices have gone up. You don't have to do as much hedging to create the same level of certain revenue in the future at 37 or 3,800 that you did at 27 or 2,800.
Yeah.
Yeah, because prices, the margins have certainly expanded for the minute, right? I mean, give them time and they'll bring them in, I'm sure, as an industry. But for now it's there. So I thought that was really interesting. So that broker in that same thing that's beating them all up, singing the praises of Ramelius. Well, you can't have it both ways, right? You can, but look at the donut is my thing. Is just look at that and look at what's under the hood and why they're doing it.
Well, I think if I was going to buy, back to the original one about what's going to give you the more upside, buying gold or the equity, it's I wouldn't. If I had a view that gold price is going up, I wouldn't buy Northern Star or Genesis because they're both on they're both in growth periods. And Northern Star's got a lot of capex going out the door to get them on this trajectory. Whereas a Ramelius or a Westgold, you're they're in a free cash flow generating period at the moment, and they have probably the most upside. And then their share price has probably, I would assume, outperformed what the gold price has done in this last year based on their free cash flow generation.
Yeah, although again, it was interesting. So you look at WAF. The other thing I did was look at all the shares and see what was the largest retrenchment they had in the last 12 months. And was it bigger than the pullback in gold? And in many cases it would be, as you would expect, because of the leverage there. But they seem to have more leverage. My observation is gold shares, particularly those with debt and no hedging, have more leverage to the falling gold price than they do to a rising gold price. So the kind of sharp ratio that you would look at for some of these unhedged companies, it's not as good as gold. So it's so my thing would be, what level of outperformance do you need from a gold miner before you take all the risks associated with a gold miner over gold? Yeah. One of the things that is interesting, and I love the way, every year when you go to deal, I wish I'd done it now, I kept a diary of every year at Diggers and Dealers of what the phrases du jour were, right? So because every year there's a theme, and before lithium and all that stuff, and it was just gold and everyone was being beaten up and there wasn't much of anything else, and people were highly leveraged to the gold price, which means high cost. Right? Yeah. To your point. Yeah. Because the best torque you're going to get from 3,000 to 3,700 is buying the guy who produces it for $3,000 an ounce. Because he goes from zero profitability, zero profitability to unbelievable profitability.
Well, look at what Aeris did for copper.
Yeah.
Copper.
They tripled in a couple of months.
Tripled this year.
Absolutely.
And they're still not making much money.
That's got nothing to do. With the price of what you're doing. That's to do with the inherent leverage in that and what's going on. So don't get me wrong. You want to express a view on tin, you go and find a tin company. In many cases, that's more legitimate. I know you guys have been talking about tin a bit lately. It's actually very difficult for an individual to get long tin. It's very easy for an individual to get long gold. Just go down to Perth Mint and buy some or open an account. So I've been very bullish tin for a number of years. You've got no choice but to express that view by being long, tin equities. Did I necessarily express it with the right companies? Probably not, but time will tell. I'm stuck in an unlisted public company with Parlour, so good luck to me. anyway, but that's Atlantic Tin looking very exciting. But but gold, you've got the choice, and so that's why the onus is on gold mining companies to try and demonstrate through the cycle that they can outperform gold on a consistent basis. And I think if you look at Perseus and people like that, you look under the hood, it's about management. It's about buying assets well, developing. That's where all the money made in gold mining is like the early years of Northern Star. Not where Northern Star is today. It's probably why Bill left and start again, right? I mean, I'm sure it is. It just stops being fun and you stop having talk. Yeah, it's much more difficult. And then you're totally reliant on people outside the room to drive the future of your business and hope everyone buys gold
How would you
faster than they buy oil.
Yeah, would you, if you put Ramelius and Westgold side by side, like you class them as pretty similar businesses at the moment. Probably Ramelius have got less growth going on because Edna May's coming to the end and Penny's finite, whereas Westgold are obviously doing the Great Fingal and the Big Bell expansion and going deeper and everything. But Westgold's unhedged, Ramelius is hedged.
Yeah.
How do you weigh them two up together? Like if Ramelius hasn't got the growth but has the hedging locked in, but Westgold is, I don't know, they're pushing the unhedged side of things.
Oh.
What's the perspective on why?
Look, so I saw, and so, you know, like, funny little world, like Wayne used to be, the MD of Westgold used to be the MD of the tin company that I'm invested in, right? Like Casbah. So I've known
He's an old tin
Wayne
baron.
for years, right? Which is now Atlantic Tin. So I saw Wayne speak 2 years ago at Diggers and Dealers, and it was his first Diggers and Dealers presentation. He said, and here's my plan, if I don't deliver on it, I won't be here next year. And good luck to him. He did an amazing job, and he came back again next year, and he delivered on everything he said. And he's, you know, I think he's changed the nature of that company quite considerably. But standing here today, you look back at the last 5 and 10 year performance of Westgold relative to the gold price, you know, and they were generally unhedged. They used to do a bit of hedging in Cookie's era. He used to do prepays, and which was a gold-denominated debt, and he would always say he was debt-free, but he always had these prepays on. But they generally didn't hedge, right, to any great extent. Hasn't been of any benefit to them because they weren't doing the right stuff in the ground.
More talking
right?
this era, but
yeah. So
like,
I don't look. I don't know. Yeah. I don't know today. I don't know who have the better prospects. But what I do know is Ramelius has a great platform, and I do know that they've been quite successful at bolting on stuff. So you say they don't have any growth. Well, they don't have any growth today, but they could have growth in 2 days' time.
Easily,
right? So
yeah.
everybody, you know, all the mug punters like me are trying to figure out what they're going to buy next and buy that before they do, get a bit of an uplift, you know.
Yeah.
So, but it's that kind of thing of, I don't know where the gold price is going. So it's really interesting. I mean, I'm so personally, my personal position is I'm very bullish gold. And I said about 3 or 4 years ago at a conference, I would happy to be saying I'm probably one of the more bullish people in the room. Whatever number you could come up with, I think I could probably come up with a number that's higher, where I think the gold price could go at some point, right?
So would you hedge?
But why do I buy gold mining? Why do I buy shares in gold mining companies that hedge? Because I know the value of my view on the gold price in the medium I don't know, right? And I don't know what's going to happen in the world. I don't know what's going to happen next. So if I see a company that's well run, that does hedging for the right reason, and I thought even if the market stopped tomorrow, they could deliver gold to the bank for the next, they could deliver gold to the bank for the next 30 weeks and get a price, even if the market was shut. I like that, because if the market's shut, you know, what does everybody else get for some reason, right? So that idea that there's some level of certainty in there, but not too much, to me, that just makes sense, because it's really about, you know, but it all comes down to when you ask management why they do it, if they're doing it because it's good reasons for the business. So I'm very happy to be very bullish gold and own gold mining shares that are hedged, because if my thesis takes 10 years to play out, not 3, they'll still be here in 10 years, right? They'll be the one that buys the next guy. They'll be there that guy, you know, like gold price collapses tomorrow. It's going to be great for Perseus shareholders like myself, because they'll get to buy WAF cheap. If it doesn't, then they'll both go on, right? But it's like that thing, there's an inherent leverage. I mean, like a gold mining company that borrows money to build a gold mine and doesn't hedge is playing Russian roulette, and instead of having two bullets in the barrel, they're adding 3 or 4. A gold mining company that borrows money to hedge is still playing, and hedges are still playing Russian roulette, because the mine may fail for physical reasons, you know, other things may happen. But as many bullets as you put in for the debt, you probably get to take out for the hedging. You know, you kind of offset that. I think Red 5's a really good example. People love to make a fuss about their hedge book. I don't know what the Red 5 share price would be today if they'd issued equity to build that mine and hadn't taken on any debt. I mean, the hedging that Red 5 has only exists to support the debt that they took on in order to build that mine. I can't remember what their share price was as they were raising the finance, but they would have to have 2 or 3 times as many shares on issue today if they did.
They did have to raise.
No, they did raise, and they raised again.
Yeah.
I mean, again, they because the mine didn't work the way that the people expected, right? So they probably had one of the most unhealthy starts for a mine. They got really unlucky. But now you look at the share price, you look at its performance relative to gold on a 5-year basis, on a 10-year basis. A persistent shareholder of Red 5 has done very well despite the hedging. Look at the donut, don't look at the hole.
Yeah.
So with those undeveloped ones, sort of talking about that, I mean, like 3-4 years ago, you had like all these undeveloped gold projects getting, taking advantage of the good interest rate environment and absolutely maxing out their debt as much as possible, and perhaps, even the hedging having to really push it over the line. And we've seen now, particularly, just from operational issues, but then also now with the gold price having moved so much in the last 3-4 years, all of this starting to unwind. When you're speaking to companies now who are in that situation, in this current gold price and sort of interest rate environment, are they more nervous than perhaps a few years ago? Or what's that conversation like?
We've got a really interesting situation happening at the moment where we're working with a couple of companies that are looking to bring on smaller projects. Smaller projects are working very well at current prices.
Trav, never mentions who these companies are bringing on small projects, because I reckon Sean Russo knows that if he does, he'll be then responsible for us ringing them up and asking, are you verified?
Yes. You're 100% right.
Yeah, so there's a bit of liability there on his behalf, so I can understand why he doesn't say. But if you are one of those companies working with Mr. Russo, or pretty much any other small company out there, you are on notice. If you haven't got a VRIFY model, if you haven't incorporated the use of VRIFY AI to give yourself as many exploration targets as possible to expand your resource, not looked upon favourably.
Yeah. I mean, I kind of think of like the progress to how do you get as far as needing to hedge in the first place? Well, first you got to find something. Well, VRIFY AI will help you do that. And then secondly, once you've found something, you've got to communicate that to the market. And VRIFY help you do that too.
Trav,
and then you can hedge.
Just thinking out loud here, would you consider VRIFY AI as a bit of a hedge itself?
It's not even a hedge; it's a sure thing. Well, actually, I can't say that.
But it's like, it's a hedge that just you probably don't.
It's maximising your probability of success, which, mate, hedging's all about, just risk management, and this is the best risk management you can do.
Yeah, you're essentially hedging the risk to zero by getting VRIFY AI. That's how now
That's what Sean Russo told me.
Now I understand myself. So, but if you want to hedge, or you don't even want to hedge and you think you don't need it, that's why you get VRIFY and VRIFY AI. Just eliminate the need for hedging at all. Banks, if when they lend you debt, if you've got VRIFY, you don't need to hedge. That's come in just recently. So if you want to take advantage of the high gold prices, get VRIFY AI.
You heard it here first.
And they can meet the needs of their financiers by either spending equity to buy put options or by borrowing more money from the lender to buy put options. What's a put option? Gives you the right but not the obligation to sell at a certain price. So today you can't lock in forwards at $3,600 or $3,700, but you might buy options at $2,900 or $3,000 an ounce. And you lock those in. So that gives you a certain price, like an insurance policy on the price, which helps support the debt. Because the bank, absent hedging in your model, runs everything still off some Aussie dollar price in the low 2000s, right? And that's not unrealistic if you think how recently Aussie dollar gold price was in the low 2000s. And given you get no upside as the bank, you've got no equity upside. If they want to borrow money, you just want your money back. The only way you're going to get the money back is from the mine, because the mine fails, you're not going to be raising equity, right? So banks have the right to be conservative. But right at the moment, we've got people saying, well, we could use puts, or you could use a collar where you give up 50% of the upside to lock in 100% of the downside. You do things that minimise your future commitments. Look, I started 20 years ago. In a couple of months, we will have been in business at Noah's Rule. And I came from the dealing desk side of the bank. I came from the sort of hedging sales and trading. And I turned up and I started saying to all these bankers, your model's broken. Like the way you lend money to mining companies is broken, and Noah's Rule, we're going to fix it. We're going to change the way mines are financed. Well, I realise that there's too many vested interests of the banks and the way it works. We've had a lot of successes helping our clients minimise the level of hedging, introduce optionality, do other things. I mean, I'm very proud of the body of work that we've done over the years and helped a lot of people get into production and stay in production over a long period of time. But the model is still broken. And what do I mean by that? I mean that the way the banks, it's spreadsheet arbitrage, right? They look at, you bring the model, they get all the technical people and all the stuff, and there's all these inputs, and then they stick in a gold price and they go, right, debt, cash flow available for debt service, that's how much we can lend you using our ratios. But if you do some hedging, well, that's at a much higher price in the model, we can lend you more money. So the debt carrying capacity is entirely tied into the spot price on the day and the forward price and how much hedging. And to your point, if you really want to gear it up the wazoo, just do more hedging, right? Now, that's fine if all the other people contributing to the model were all right. If everyone's right, the hydrologist and the buddy people with the work index on the stuff, and now I'm getting way outside my area of expertise, you know what I mean? But all these other inputs that have gone into the stuff, because if the mine doesn't work, or it's a year late, or 6 months late, you've got to start rolling that hedging forward. First slippery slope, you've got to roll the hedging forward. Particularly the price has gone up. So we said from day one, look, I'm just a mug off the dealing desk, but it seems to me like you make these mines work on a spreadsheet and you ignore the quadrants that the gold price goes up and the mine underperforms. You ignore that's a serious quadrant. And I guess from lived experience, Rothschild, we got caught in the late 90s where my banking colleagues brought mines into existence should never have been brought into existence by doing too much hedging, and then the companies worked too hard to try and make them work, not the amount of work underground. All of a sudden you have a seismic event underground or whatever because they're pushing it too hard. The mine fails and we're owed more money than we lent. We had to go and buy the gold back for the hedging. We'd lent 40 and we were owed 80. It takes a long time as a bank to get to recover from that. So I was like, that was something that was really embedded in my thing, that you're doing it wrong. So we would still argue to this day that generally the right amount of hedging on a risk-adjusted basis, whatever the bank tells the client to do, the client should be trying to do half that much hedging. And once you're in production, you might increase it. Sure. You might move to more because there's more certainty. But that gap between when you get the money from the bank and when you produce your first ounce, like if there's a 2-year period of time where you've got all those hedges and you've got all that time to prove all the things in the model that weren't quite right and how far the world can move in that time period. Yes, it's good for the bank if the price goes down, that the hedging might actually save a mine that should never have been built because of price. But if price goes up and the mine underperforms, hedging has been an enormous drag on that, right? And so that's why we're always arguing with banks to do the least amount of hedging that we can and try and get more optionality, how you feel that, or just encouraging clients to either not proceed or raise more equity. Everything's a trade-off, right?
So because the banks they're making a margin on that bit of hedging, aren't they? Like they're not, like let's say Calidus for instance, like Macquarie aren't making shitloads on that hedging.
Oh no,
right now that's already been sorted.
Macquarie borrow,
but they get a margin on it. Don't
Macquarie in the same way they borrow your money to fund my mortgage. If you've got money on deposit with them and I'm borrowing from them, they go out and they borrow gold from someone like a central bank or someone who holds gold. They borrow gold from another bank. They sell the gold. They put the money on deposit. Yeah. If the value of those hedges in today's market is less than the gold price, and you have an insolvency situation in any mine that fails, the bank has to go and buy gold in the market to repay the person they borrowed it from, and the secured creditors are up for the loss on the difference. No, they don't participate. I mean, someone said to me the other day, or something about, how much the bank, did the bank's done well on that hedge? No, they're like, the bank lays all its risk off within a minute or half an hour of doing the transaction. They're earning a margin.
Bit of margin.
They're earning a margin, and the margin on hedging overall is more than they make on the debt, which is why you'll see these CEOs that always crow about the margin on their debt. And you'll know they're the ones that the bank gave them quite a low margin on the debt and then buried all the fees in the hedging, right? Because that's public and this is not. So, that you're just trying to minimise the costs of doing that. But it's things like adding one more. Banks have a tendency to try and add one more year's hedging. Instead of doing 3 years of hedging, they want to do 4, just to make the model a bit more robust. We would argue that you're just creating more risk. It's just a different type of risk. You think you're offsetting one thing, but you're adding new things. And on a risk matrices, too much gold is too much hedging is as bad as not enough.
You painted the picture last time we spoke of what happened between 20 and 10 years ago, or 20 and 5 years ago, of all these companies raising significant amount of equity.
In the 2000s,
Yeah, in the 2000s. Newcrest was one example you gave.
Yep.
In, I think, the mid-2000s, essentially closing out $2 billion from hedging. Do you think that's something we're going to see again, given we've seen this kick up in gold and these hedge books look bad?
Well, the first thing I would say is, last count, maybe there's something like 6 million ounces of hedging in the world, or 7 million ounces of gold producer hedging in the world.
Way smaller than
in the
what
late
it is.
90s, there was like 110 million that was declared, and now with hindsight, looking at some of the Sons of Gwalia, exotic derivatives and stuff, maybe there was 130 or 140 million, right? So the order of magnitude is so once people started buying those hedge books, it actually drove the gold price up, which forced more people into it. So I think it's very hard to see a replay of that. I mean, you've seen it to some degree. I mean, you've seen. I would argue that, everyone said the last hedge book of the 2000s got bought back in 2012 by Anglo, but that's not true. The last hedge book, remnants of that would have genetic history in their hedges going back to the 2000s would have been the Regis hedge book bought back in the last 6 months, right? So that's actually the last of those hedge books to be bought back, just a very long time after, right? So that's gone. Going forward, if the gold price goes up really dramatically in the next little while, will there be discussions about mining companies, people putting pressure on them to do that? Brokers will be putting pressure on them, absolutely, because they'll do the raising to help raise the money. Like, you guys talk all the time about incentives, right? Like, all of this concentrate on the whole and not on the donut is all driven by these brokers, because hedging and debt are just not good for business for them generally, right? That's my view. That's the reality, and a lot of them it's out of ignorance. They just don't fully understand. And fund managers then they tell the brokers, well, we want the people that are unhedged because we want that, but they just rent the exposure, right? They come in the register, and if they change their mind on the gold price, they do it. And by the way, if they decide the gold price is going down, the first companies they're going to short sell are going to be the gold mining companies that have no debt and have debt and no hedging. Yeah. That's what we saw in 2013. So are they going to look? I would imagine that most of the companies now, with the level of hedging you've got, less than a year's production, if the gold price really persists, boards might say, let's accelerate our deliveries into hedging, or let's stop hedging, doing any new hedging, and let's just keep delivering to what we've got. And so, like Ramelius have said, we were 160, we're moving to 100. I'm not fully privy to all the discussions they had around that, but basically purely on their public discussion of that, they're just more mature in their profile. They can lock in higher prices. They don't need to do as much. I think that's the kind of thing you're probably going to, you might see around. The exception will be new projects, to the extent that any single asset company gets sponsored by a bank to come on and does the existing hedging, then that would come back to your question. You won't need to gear them very much to do it at the current time, but I don't think many of those single asset companies are going to get up, because they'll just get bought by the existing. They're more likely to get bought by the existing producers and put into their portfolio, right? But look, you never say never, so it could happen, but it would have to be incredibly dramatic. And unless your all-in sustaining cost got close to or above the price you were delivering into hedges, what's the benefit for shareholders other than marketing? You think it's going up tomorrow, and so better get out now, right? Like, you're better off to mine the gold. I believe you're better off to produce the gold for 1,200, deliver it in 2,100, than buy back your 2,100 hedges at 3,500, crystallise the loss, and then hope in the future that you sell the gold for more than 3,400 in the future to justify that position. Does that make sense?
Yeah. I don't suppose you were doing your weeks by gold price analysis 20 odd years ago, and you could see 100 million ounces.
Those guys had 150 weeks. They had 200 weeks. Yeah. No, some of those guys, Barrick, people had hedges out 5 and 6 years at 50% and things. So they kept on doing more, because the price got lower, and they were just trying to keep mines open, and then they were doing exotic, Sons of Gwalia, exotic derivatives that multiplied the exposure. So it's a totally different world. I mean, I think, excuse me, but just I've got the map here. Like, the largest hedge books in Australia now are sort of 70 70 weeks. Oh no, the top three they're sitting there of any size are 65 weeks of production, right?
Yeah.
So in fact, no, that was last quarter. So coming down, so in that, so about a year. So the biggest hedge books are about a year, and that's probably 30%, like Northern stuff, like the equivalent of 30% for 3 years or whatever it would be in that order. So, or 25% for 4 years, I think in their case. So, yeah, I mean, the likelihood of them buying the back, you'd have sitting around the board table like. You go to the shareholders and go, if you have to raise equity, different if you're doing it out of free cash maybe or accelerating, but the idea that you would go to shareholders and raise money and say, give me money so I can buy a gold bar.
Yeah.
Like, I'll go and buy a gold bar myself.
Yeah.
I'll sell your shares. And that was the whole fraud of the 2000s. Yeah. I remember writing an article about 2007 or 2008. There's no prospectivity along strike or down dip on a gold bar. Why are you giving these people who stand up and talk about all their prospectivity along strike and down dip, why are you giving the money to go and buy gold bars to pay back the previous debt? Just go and find the new guy who's building a new mine clean and locking in these prices to start, like a Perseus and people who were getting going in that 2010, 2011 period. I mean, the smart people were buying the juniors that were taking advantage of the high prices, not getting involved in the bloody majors who were just diluting their shareholders up the wazoo. I mean, Newcrest's share price never really recovered from what they did in the mid-2000s.
Yeah.
So is that the mechanism you're talking about for the put options?
Yeah.
Do you think we'll see anything like that in the future, where instead of having debt with the hedging that has to go with it, they can get debt but with put options?
Well, so I would hope.
What is cheaper? What makes you more money?
Well, it all depends where the gold price ends up, at the end. Because if the gold price is not higher than the forward price over the life of the project, then doing hedging would have been more sensible, right, than doing it. I mean, we dealt with a gold mining company in Canada, Atlantic. It only became well known in Australia when Bob and the guys at St Barbara bought it, right? Yep. Atlantic, on the sale to St Barbara, made an 11 times uplift for shareholders, and an 11 bagger from announcing their project financing with Macquarie 5 years before the GDXJ went down over the period, and they had an 11 bagger. They were like a 25 cent share, and they borrowed $130 million from Macquarie Bank, and they hedged it up the wazoo. Absolutely, it was like 70% hedge for the first 4 years of production. Yeah. I hadn't seen a transaction done like, we were involved in the transaction, we helped them design it, and the company's instruction to us was to minimise equity dilution, right? And so they said high level of hedging. The chairman of the company, Stephen Dean's an Australian guy, used to work for Normandy, for Robert de Crespigny, understood hedging, understood the risks he was taking. That hedge book was out of the money for its whole life, cost money, and then when St Barbara bought it, they took the hedge book with them and spoke to the treasurer, the CFO of St Barbara after it happened and said, we're very familiar with that hedge book. If you need a hand, give us a call. He goes, it's bloody terrible. It's out of the money. I said, it's yours now, mate. I mean, the shareholders of Atlantic think that hedge book's the best thing since sliced bread, because the dilution they avoided at 25 cents is why they got an 11 bagger. Yeah. So, and I went to America, then walked around telling everyone how clever we were, that we'd helped Atlantic, thinking that all these Americans would finally get religion. Like, hedging is terrible. We'll just go back to the equity market and just, that's their alternative. They just treat the equity market like a handy bank. So, but it's coming back to your point about options, right? There are windows of time where the gold price goes up dramatically, and you can now buy options at a strike price that's well below the price, but is still well above your all-in sustaining cost and above the price the banks otherwise put in the model. That's in the window we're in right now. So we've written to our clients in recent weeks and said, hey, the window of maybe doing put options is open. You have to spend money, you have to borrow money to buy them, or do a collar. I think we showed a client a product where they could, for every 1,000 ounces they committed at a higher price, they could lock in 2,500 ounces at a lower price. And if that lower price is 3,000 or 3,100, like until a couple of weeks ago, everyone thought that was an awesome price. Now we go up here for 6 weeks, everyone goes, 3,100. Well, you wouldn't do anything there.
Never going back there.
Well, and the last time, Matty, that we saw a window where we recommended to our clients to think about buying 2 or 3 years worth of put options was in 2011, 2012. And a similar thing where you could buy 1,600 puts and underwrite the next 3 years of production for about 4% of revenue, equivalent to 4% of your expected revenue. And people said, why would we buy 1,600 puts? It's 1,850 and Eric Sprott says it's going to 2,500. Like it's never going back there again. It went to 1,150, right? So I don't know where the gold price is going, but what I've said to our clients is, I want you to think about buying like 3,000 puts or 3,200 puts for the next 3 years. I want you to think about the amount of money that you would have to spend to do that. But it's not because we think the gold price is going back below 3,000 or 3,200. I want you to have a conversation with all the technical people in your business. I want you to have a conversation with all of your stakeholders and go, how might we run this business differently? If we knew that we could sell every ounce we produce for the next 3 years for 3,200, like what might we do different to our peers? Well, could we pay a special dividend? Could we go far more aggressively on that thing? Like, how differently might we behave than all of our peers? Because whatever you say about, you stand up at the conference and go, gold price, yeah, fantastic. Every night you go to bed going, please God, don't let the gold price go down, because I've got my options, I've got 3 kids in private school, I've got, you got all that stuff, right? My wife wants a house in Yell. I mean, that's what happens. We talked about that. That's the beach house, the school fees cycle of the way people hedge, right?
Dividends is the interesting one, because if it's up and you flog a heap out and then it goes down, you're like, shit, I wish I could have them back, because you've got no certainty.
Absolutely. So if you said, but I challenged gold mining, company MDs, people talking about capital management and share buybacks and things like that. Like, I got puts, now I'm going to do a buyback because I know I'm going to create this much cash with a level of confidence. Is that more interesting than the guy down the road who's unhedged 21 times? I think so. It's what you do with it. But again, that comes back to, Matty, why are you doing the hedging? So if you heard someone said, I'm buying a whole lot of puts, and you said, why are you doing it? Oh, well, gold price goes into 2,000, we'll close them all out, we'll make a fortune. I go, wrong. Like, it's not about what you might get out of the whole, it's how much bigger you can make the donut, right? And and I think that's just, because otherwise it's uncertain. You have to work on that. We're in an uncertain world. No one knows what's going to happen. We've got a change in president of the United States coming up. Like, who knows what's going to happen there? Particularly now you've got this third contender. If people starting to take Bobby Kennedy seriously. I was at a gold conference a couple of weeks ago. People were asking for our view on whether Biden or Trump, like, what's the difference in the gold price? I go, like, oh, seriously, I have no idea, right? But it could have a dramatic impact. The yen, no one's talking about it. The yen moved 40% in the last 12 months. One of the major currencies in the world just devalued by 40%. So everyone in Japan's really happy if they own some gold, right? Like, hard assets. So if this is the beginning, or this is the unraveling of what happens when governments get too much involved in, interest rates and markets and manipulating and all that stuff, if Japan's the kind of poster child for what could happen next, I can see people all around the world saying, oh, I wouldn't mind a bit of gold. And the best time, I think, for the gold is when gold goes up and no one can really explain why. Do you know what I mean? Like, there's these moments when the gold price is going up and all the experts who have generally been bullish, all of a sudden go, oh, I think it's got a bit far ahead of itself, or whatever. I go, like, it's not matching my model or real interest rates or something. And you go, like, I've been in the gold market for 40 years, and every time people have one method where they think works, you can be guaranteed that's going to break down and people are going to start attaching it to something else. And it mightn't even be the right reason. It's just they're both going the same way at that period of time. But all over the world, there's lots of people from Japan to Eastern Europe. There's a lot of people in that part of the world, and they all don't trust paper money.
So
they'll buy gold.
Yeah, how much, like, I don't know how much these actual options cost. Like, say there's a 200,000 ounce producer and they want to bloody get 100,000, half their production as a put option at 3,300 going forward. Like, what does that cost the company to put that in place?
Because everything moves so quickly, like, so 4 weeks ago, when we sent out the note and to clients, and market had gone up very quickly, gold's at 3,600. We were talking to clients and saying for like 3 years you could buy a meaningful strike, 3,100, 3,200, something like that, for the equivalent of the 3% of your revenue. So that's $100 an ounce, roughly, right?
For how much of the production?
For each year?
For every ounce that you, every ounce that you buy, every ounce for 3 years that you buy, the cost of that will be about 3% of the revenue that you're expecting in that period. To cover 100%, well, you wouldn't cover 100%,
all of that.
Yeah, 97. The other 97% that's not hedged, but it's in that order of 3%, right? So that was just roughly. So, and that's very unusual. Now, it was about 4% back in 2011. But the reason for that is gold price has gone up dramatically. option model, most people are buying call options at the moment. Like in the world, if you're someone who it makes prices in gold options, very few people are ringing up to buy puts. But lots of people are ringing up saying, oh, I need a bit of upside cover, I need some call options, I need a bit of disaster. I better put in my tail risk in my hedge fund, I'm going to buy calls on the gold mine to give me leverage to the price going up. So if you're there and you're selling lots of those, it's like a bookie at the races. If everyone's buying the upside things, that's the favourite. You wind in the odds in, or you make them more expensive, right? And then the other thing you do is then the VRIFY, you wind out the odds. If you think of the old country bookmakers, so they make the puts cheaper and cheaper. So we say to our clients, like this now is kind of like these options are cheap relative to what we normally seen. And they don't have to just be cheap. It's not just about you can only have to spend $30 an ounce. For your $30 or $40 or $100 an ounce that you spend, you have to get a meaningful strike. To do that, you need the price to have gone up a long way. And one of our clients put it beautifully. He was, he said, if we could lock in 3,200 for the next 18 months for X dollars, if I'd come to the board 8 weeks ago or 10 weeks ago and said, if we spend that amount of money, we can lock in 3,200 every ounce, they'd be all over you like a rash when it's at 2,800. But all of a sudden it goes up, for 6 weeks it's higher because, you wouldn't be spending money to do that. I mean, who knows where it's going to be, 6 weeks from now? I mean, no idea. So, that's what Noah's rule is, predicting rain doesn't count, building arcs does. And that's why we chose that name. All we're trying to do with our clients all the time is to say, like if it pisses down, you float. That's... And if it doesn't, well, everyone laughs at you. This is, a hedge book right at the moment is like a great big wooden boat in your back garden. Everyone's going, you dick. Yeah. That's, hey, I'm still here. Yeah, I spent a bit of money on the wood. I've got the boat, but hey, who knows? Could still rain next week. It's that, that's just, you don't know. So it's all about just creating that level of certainty to be able to plan with confidence. So that's why I don't see a single hedge book in Australia to be in any way concerned about, but you want to see people, you want to see the prices that they're getting increasing. You probably want to see the volumes coming down a bit or consistent, but at much higher prices, depending on their planning.
The concerning ones are in relation to the operation.
Oh,
because they need it. They need the hedging gone because the operation isn't performing.
No, absolutely. And so in that circumstance, if a company in Australia goes broke because a mine fails, and when you look at all of the people that are owed money, right, and one of them is the bank that's owed that amount of money and they're owed that much more because of hedging, right, you can't beat up necessarily the CFO and the finance team for that, because if the mine didn't work because someone got the grades completely wrong or the mine plant wrong, that's down to the engineers, right? Like you when you go into the mine finance, you go in on the best will that everyone's put their numbers in and you've got to that level. I mean, every project finance I've ever seen that's been done has been done the best will in the world, that if the mine works the way it should, then it would be okay. But we've looked at a lot of them and gone, but they never work the way they should, right? Like they're always late, right? They're always late. They're always over cost. You've got to allow for that. So that's certainly when we're sitting with our clients, they go, I know the bank will lend you 100 million, but you shouldn't borrow more than 70. Because if you borrow more than 70, you have to hedge more than X, and if we were you, we wouldn't do that. And I think that's where that comes in, right? It's you've got to know what your own constraints are. You've got to know what the risks in your own project is. You've got to know like the longer you're going to be from where you do the hedge to when you have to make that first delivery. All those things, and you have to wind back accordingly. If that means you have to raise a bit more equity, then you have to raise a bit more equity, right? But because there's no magic pudding in hedging. And that's really the problem that you were talking about in the 2000s. The problem was somewhere in the mid-1990s, hedging became the magic pudding. Yep. Hedging became the way that executives could keep mines open that should have been shut.
When the price is going like that.
The price is going, and of course every time you do a hedge, it goes down, the hedge is in the money, you think you're a genius. And you go like, and I met treasurers go, I don't know why we bother having mines, we make so much money out of the hedging, really we should just stop that and just try to go, mate, the only way you can put that hedge on is because you've got a mine, right? The question is, should you just not close the mine and send all the big yellow toys back? You go, well, we're in the business of mining. And if you go back and look at all the headlines in the late 1990s, companies just used to compete on who was the biggest producer. Because the gold price had to go up eventually, and when they did, they were the one that were going to offer you the most leverage, which is just the most, it's the most ridiculous premise that I would buy you because you're bigger than him,
Companies still like doing that.
No, I know.
Northern Star, we're going to get to 2 million ounces. Don't look at the margin.
To what end?
To
what end, right? So, no, it's going to be here in some form or another. We are in a bull market. This bull market will end. You want to be in the companies that are going to be able to sustain themselves. I mean, some companies in the 80s and 90s in Australia made lots of really good money mining gold in an environment where the gold price was falling. But to your point before, over time, costs did come down as well. Costs did abate. Oil price fell. In companies like Norman and others for a long period of time, people were very profitable mining gold in Australia in a falling price environment, but in a different economic environment, right? So you can sustain, but you've got to be able to get through. And I think what we saw in 2013, 14, 15, 16, we saw that period of time where everyone got hugely excited in 11, 12. It's similar, different world, but similar sentiment to it. I think the world environment's different now, but the sentiment's the same. And everyone got very excited and started borrowing money and not hedging and doing all that stuff. And then in 13, almost out of the blue, bit of a rug pull and the gold price collapsed and everyone cried conspiracy, but it wasn't conspiracy. It's just that generalist investors who'd been in gold and had done very well out of it felt comfortable to go back into general equities. Yeah. And they literally just sold all the gold. I mean, you can see it in the gold ETF volumes and their behaviour leading up. Generalist investors, I actually think we're at the other side of the cycle. My personal view is we're very close to the point where generalist investors feel the need to buy gold. If the Dow gold ratio keeps going down below sort of 16, generalist investors might start buying gold because gold's not expensive relative to general equities. If you think how far equities have gone in the last 5 years.
Yep.
And gold's been keeping pace with general equities now for the last 5 or 6 years, which is also pretty amazing. No one talks about that, but you've done just as well just being long gold as you've been most of the indices in the world in the last 5 or 6 years, unless you're really heavy into tech, right? Yeah. So gold's been doing really very, very well. So anyway, but yeah, I mean, who knows, right? So you've got to deal with all of that, and it's a balance, and that's like some of the best companies in Australia that have been involved and delivered the best success for producers have been companies that hedged. Saracen, Northern Star, Regis in its early days, Capricorn now, Ramelius. Like, I don't know why these brokers get so bent out of shape about it, really. It is.
That's what you say.
We know why.
You could be making more money now, but as you said, it's on an earnings per share basis over the longer term, where they didn't have to tap the market for 15% of their capacity.
Yeah, when their share price was 20 cents or 10 cents or whatever, right? So those are the shares you never get back. I mean, everyone, hedging more broadly, people talk about derivatives or the danger in derivatives. The most dangerous D word in the junior mining, mid-tier mining space is dilution. Like no one ever talks about that. No one ever goes, you shouldn't have done that raising last year. They probably do, but the time, like everyone can talk to you should have the brokers should run a table of the cost of all of the previous equity raisings that a company did and beat up on that, not where their share price is. If they're legitimate on this way, they keep on looking at the negative mark-to-markets on the hedging, because it's one or the other.
That was the biggest takeaway I had from our first conversation. It was like, compare the hedging done versus the dilution not done.
Yeah, absolutely.
Yeah.
It can't be looked at in isolation, that's for sure.
No, it can't be. They do. Of course they do. With hindsight, they do. But yeah, it can't be. You have to look at that thing. And I think the Atlantic example I gave before is the best one. Like, it's an 11 bagger, right? And it's just great. But notwithstanding that, you show that to all these people who have died in the world. It's a very religious, non-hedging, hedging view. And in North America, you could show them that. It'd be like the Earth is still flat. You've just shown me the Earth is round. You've just shown me avoiding dilution is good. No, sorry, doesn't work here, right? It's just it is that religion. And Australian mining companies have done better in general. A lot of their North American peers, because they do and respect that. My view is that Australian companies, particularly ones that hedge, you will generally find they're people who behave like owners. Right? Whereas most American companies, or many of them, they act more like agents. There are exceptions there, like Lundin and places where they clearly are owners. But in America, when you meet the people and talk to them, like the executive teams or the bigger, they're all agents. They're all optioned up, and it's a different world. They're not behaving like owners. Owners are always thinking about cash flow and making sure they can repay the debt without having to issue more shares. Right?
No shortage of them in Australia either.
Sean, I think that's a great note to end it on. Appreciate you coming down, making the time.
Pleasure.
Last question to end it.
Last question.
What, between currency geopolitical, macro in general, what's circumstances which could see the gold price, Aussie gold price, go back down to 2,800 quickly? It's gone up to 3,600 pretty quickly. What could happen? And everyone thinks it's staying there or going. Everyone thinks it's staying there, but what could happen in the world that could send it back down?
Well, if nothing happens in the world, and you saw the US dollar gold price just kind of keep bleeding off a little bit, and you saw the Aussie dollar just start to go up a little bit because the US dollar just starts to release a little bit. The most dramatic, if I went away for 4 weeks or 5 weeks and came back and then there was a very dramatic move in the $80 gold price, my assumption would be it was the sort of alligator jaws shut that had been open for a very long time of a rising gold price and falling Australian dollar. Because in my working life, 70% of the time, gold and Aussie go in the same direction, right? And then you've got these 15% at either end where you get what we call purple patch, where gold's going up and Aussie's going down, or black spot where gold's going down and the Aussie's going up, right? And we've been in, like we say to our clients, we've been overdrawn in the purple patch favour bank. Like we have for most of the last 2 years, we've had rising gold price environment, falling Aussie. So the most likely thing that could do it would just be a kind of benign position as everyone kind of tries to close their positions in and not be too exposed in the run up to the US election or something, and you find gold just drift off a bit and Aussie go up a bit, and that combination is generally the easiest way just to pull the rug out under the $80 in the very short run.
What would be the thing that's gonna, because the $80, if they're while they're raising money, printing money over in the US, that's going to keep the $80 going down.
If we were to increase rates, that would increase flows, or if iron ore were to do well, would be the two off the top of my head.
Yeah. I mean, the Aussie's been confounding people, right? Because iron ore's price has been strong. People, there's people who go, it's all to do with the iron ore. It's all like interest rate differentials. There's some people that died in the wool. Like that's the major thing. And the interest rate differential at the moment is certainly anti the Aussie going up. Right, so you can get US dollar interest rates higher than Aussie dollar interest rates. That's generally a negative for the $80. The interesting thing is that the Aussie is at like 30-year highs against the yen. So if something like we're at over 100, right? Like anyone who's going skiing or going to Japan recently knows like just how cheap Japan is. Stupid cheap, 40% in 1 year. So if all of a sudden that reverses, if for some reason the Japanese make some announcement or whatever, does that have an impact in some way? What would happen? That probably more likely to have an negative impact on the Aussie. But I think like at some point, if there's a commodities upcycle coming, which again my personal position, and I've spoken at conference about this for the last couple of years, commodities are ridiculously cheap relative to general equities. It feels like the late 90s. So at some point we're going to have a period of time, I think, where, and it feels like it's starting now, where commodity prices generally are going to rise. And investors are just going to take money out of very expensive high-tech AI stocks and various things and go, oh, this is just too expensive. I'm going to take some of this money and I'm going to buy value, right? Oil and gas, mining. If commodity prices start to rise more broadly, keep an eye out for all the commodity currencies. If the Aussie, the Canada, the South African rand, the Brazilian real, the New Zealand dollar, if they all start to sort of turn, and that would generally be US dollar, coming off its highs. So US dollar starting to weaken, maybe the yen starting to strengthen again, euro going up. But if you saw the commodity currencies going up, then that was one of the greatest signs of the beginning of the last commodity bull run in 2002. All of the commodity currencies all kind of turned up almost in unison, because all around the world, big asset allocators went, okay, we need to have an inflation hedge. We need to be exposed to commodity prices. The most liquid and deep market, the first thing to do, if you've got lots of money, put it into the commodity currencies, right? Because if we're wrong, we can get it out again quickly. Once we're in the commodity currencies, maybe that man at Goldman Sachs is right. Maybe we should buy some of the Goldman Sachs commodity index basket. Maybe we should give the nice man down there $1 billion to go and buy a basket of, commodities. And then that starts to drive commodity prices up. In that environment, the Aussie could go up quite dramatically. I think it's from 2002 to 2007 or something like that, the US dollar gold price went up 70% and the Aussie dollar gold price was unchanged. Flat,
wow.
right? Yeah. And that was just the Aussie matching strength. And that's that's not as extreme as you said. What could make it go down? I think the bigger risk over time, I think, for $8 producers is we're in the sun right now, having this amazing Aussie dollar gold price, but we might still have this amazing Aussie dollar gold price 5 years from now, and US dollar gold price is up 50, 60, 70%. Rational investors, international investors, are going to be saying margin expansion in the US, all those expensive producers now making money, Aussie producers, their margin in US dollar terms is shrinking, and the flow will be out of Aussie equities into US equities, which is what we saw in the early 2000s. Like early on, we got all the benefit of the weak Aussie. Now I'm getting a bit ahead of myself now. That's not in the next little while, but that's one of the bigger risks, and that's why it goes back to that guy from Sprott. Hedge the costs. Like, one of the biggest impacts for $8 producers relative to their peers, not their international peers, not relative to their domestic peers, is in a rising gold environment. Aussie dollar producers are just not as attractive as American, US dollar producers. Yeah. Or the Africans, for example, are more US dollar based.
Yeah.
And it's interesting, we always talk about the US dollar gold.
Yeah,
but exactly
absolutely.
like you say, Japan, Australia, these were all smashing through records last year, not just this year, when the US dollar gold did.
Yeah.
If you'd have been holding gold and you're Japanese, you'd have been super, super thankful for that. The same goes for a basket of
Absolutely,
currencies.
and all this talk about Chinese potentially devaluing because of the pressure of the weak yen is having on them. So Chinese obviously trying to buy gold as well, and that. So it's just like price of gold didn't go up, value of money went down.
Yeah.
I mean that's the way the real hard nut gold people think about it. The price of gold is gold. It's just that's just showing you that the value of your dollars went down, and that from a purchasing power basis, that's right.
Bloody sensational, mate.
Beautiful.
Oh, I
Awesome.
love it. Right, this is our territory. I love listening to this shit. I could do it all day.
Yeah.
Mate, thanks for coming up to the bloody penthouse.
Oh well, nice
She's
to be
the top floor.
No, absolutely. No, I'm very. You guys have come a long way in just over 12 months.
Having a go, mate. We're we're learning a lot.
Can I say, I told Trav the other day, director's special, just awesome.
Yeah, it's funny.
Really good job.
We're really
Appreciate
happy.
it. Thank you.
Fantastic. Thank you.
Really happy with it.
Yeah, it's very good.
Oh, I'll fucking read it myself. I'm like, shit, I've got to try and keep up with all these news articles that JD's finds. I'm like, this is a good tool. So
That's when you know it's really good.
I read it
spread
today.
the love, everyone.
I got down to 5 lines today. Saw someone had called me a couple of weeks ago. I saw they'd just got something done. I just picked up the phone and rang him and said, okay, time to talk about whatever. So, no, it's great. It's very good.
Pleasure doing business,
awesome.
mate. Nothing that
thank
a
you.
brown paper bag won't fix for that sort of stuff, mate.
Mate, he's bloody. Tell you what a great bloke to talk to about a niche topic in the mining industry. I just love it. I can't get enough of it. He's an infectious hedging guy, old Sean Russo.
He loves it. I love speaking to people that love their thing.
Yes,
and he loves
I was
his
about
thing.
to say that exactly.
Yeah.
So, and you knew from the first day he walked into the office and didn't leave for an hour and a half. Mate, he didn't even move his feet for an hour and a half. He just delivered a hedging filibuster, and it was just. I had a meeting. It was funny because I remember I had to go out for a meeting.
Yeah, I remember.
And the meeting took an hour and a half, and I walked back in, and you're all standing in the same spot. I'm like, fuck, your legs must be sore. He's just, mate. Thanks, Shawnee Russo. Love your work, mate, and we really appreciate all the knowledge and support that he gives us as well. He's a great advocate for us, so we can't thank him enough. Thanking all the partners too, Trav. The bloody ones in the show. VRIFY, mate. Just eliminating the need for hedging at all, and WA water bores, finding the water you have and don't think you even had.
In some places in the world, Matty, you would pay more for water than you would the minerals in the ground. And James helps you do that.
Yeah, get James will help you find water so you can sell it. Mate, speaking of, and then you can bloody pump it into a GetWet bladder with GetWet Solutions, DSI Underground, Silverstone CRE Insurance, Brooks Airways, K-Drill, and Trav, who do you use for your ASX trading data?
Spark. You Spark. Spark traded by Iguana too. Adam Rand's legend.
How fucking fast is it?
Mate, I think it's literally like responds before the data's there. It's amazing.
Yeah, I think bloody Zuckerberg needs to get on him with how they're like connecting the brain to the glasses and all that shit. Yeah, I think bloody Spark and Iguana, they're at the frontier of it. Righto, hoodaroo, money minus.
Hoodaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.